Let's get brutally honest for a second. Most people aren't broke because they're lazy or unlucky, or that the universe somehow cursed them with bad money vibes. Most people stay poor because they play the game of money without ever learning the rules. Imagine sitting down at a high-stakes poker table in Las Vegas while everyone else knows the patterns, the math, the probabilities, and you're just out there hoping a miracle saves your hand. That's exactly how most people treat their finances. They keep earning, keep spending, keep believing that someday a miracle raise or an inheritance will push them out of survival mode. Spoiler alert, it won't. So today, we're going to break down exactly why people stay poor and the steps you can take to escape. Not fluffy, think rich nonsense. Not manifesting money by staring at a vision board. Real, practical, numbers-backed strategies that anyone, yes, even you watching this from your apartment with bills, can use to build wealth. If success is your goal and you're ready to level up, make sure you subscribe. Every video is crafted to move you closer to the life you deserve. Let's get to work. Number 1. Stop trading all your time for money. If you want to stay broke forever, here's the surest formula. Keep exchanging every waking hour for a paycheck, because that's what most do. They commute, punch in, grind, and by Friday they're counting dollars that vanish by Sunday night. This is the hamster wheel of poverty. The wealthy understand something different. They treat time like a limited asset and money like a tool that multiplies it. If every dollar you earn requires a piece of your life force in exchange, you will never build lasting wealth. The clock will always own you. Think of it like this. A day has 24 hours. Even if you land a promotion that pays you $80,000 instead of $40,000, you still only have those same 24 hours. You just raise the rate at which you're selling your time. But investors, entrepreneurs, people strategically building portfolios, they don't scale by hours. They scale by systems. When they buy Apple stock, it works for them after hours. When they invest in rental properties, tenants pay down their mortgages 24/7. When they buy dividend-paying ETFs or stocks, cash flow arrives even if they're sleeping. If you only ever rely on a paycheck, you're effectively chained to an hourly leash. Even at $200,000 a year, you're still shackled because if that job vanishes, so does the income. Meanwhile, someone else with a smaller salary but cash flow from dividend stocks or real estate is genuinely freer. Poverty isn't just having no money. It's being locked into trading your life energy for survival. That's why making the shift toward assets that produce passive income is non-negotiable. Number 2. Stop worshiping consumption. Poor people buy stuff to look rich. Wealthy people buy assets to become rich. And the middle class? Well, they max out their credit cards trying to keep up with both. If you've ever walked into someone's home where there's a brand new flat-screen TV on the wall, but no emergency fund, you've seen how consumption keeps people broke. Consumption isn't the enemy. It becomes dangerous when it eats tomorrow's freedom just to soothe today's insecurity. And here's the kicker. Most people claim they don't have enough money to invest, but they somehow have enough for streaming subscriptions, daily takeout, and luxury brands. Poverty often hides behind justification. Wealth hides behind sacrifice. Number 3. Stop ignoring the math of compound interest. Story time. A guy I knew started putting just $150 a month into an index fund that mirrored the S&P 500. He wasn't a millionaire. He didn't have wealthy parents. He was a factory worker. But he started young, and he stayed consistent. Fast forward 25 years, he's staring at over $500,000, built from habits, not miracles. This is the silent force that either builds or breaks people. Compound interest. The same math works to crush you with debt or reward you with wealth. Credit cards running at 20% interest trap you forever. Investments compounding at 8% unlock freedom quietly in the background. People stay poor because they keep ignoring this universal equation. Poor people think wealth comes in sudden windfalls. Winning the lottery, scoring a hedge fund opening job, or inheriting money in America. Wealthy people understand that money snowballs when it's allowed to roll over decades. The person who invests $500 a month for 20 years quietly surpasses the flashy spender driving the leased BMW. The math is cold. You're either compounding debt or compounding wealth. Neutral doesn't exist. Number 4. Stop believing you need a big break. Here's one of the biggest myths keeping people poor. The belief that wealth comes from a dramatic single event. That fantasy of striking gold, stumbling into some viral business, or hitting an early IPO allocation that explodes into millions. None of those things are impossible. But banking your financial freedom on them is gambling, not planning. Entrepreneurs who suddenly make millions usually spent years failing in silence. Investors who lucked into Apple stock or an early IPO were already studying and consistently putting money into opportunities. Real estate moguls who look like overnight successes have stacks of boring rental properties they managed at scale until the cash flow became undeniable. The reality is boring. People escape poverty with systems, not headlines. They create budgets and actually stick to them. They buy index funds monthly without dramatics. They reinvest dividends instead of blowing them on quick dopamine. They build small businesses on the side that eventually replace their paycheck. That's how equity growth works in real life. Not lightning bolts, but steady rain. Number 5. Stop making emotional money decisions. Money doesn't care about your feelings. The market doesn't care that you had a rough day and feel like treating yourself. Your credit card company doesn't care you were stressed when you spent $700 on gadgets you can't even name properly in 6 months. Emotional money decisions are poverty traps. When Apple stock dips 20%, an emotional investor sells in fear, locking in losses. A disciplined investor buys more, knowing dividends and stock market appreciation over decades will balance the storm. When rent feels too much, an emotional spender upgrades to a fancy apartment instead of house hacking with roommates or investing in rental properties. By the time they've bled cash flow for years, they're back at square one. Create cooling off rules. For purchases above $100, wait 48 hours. For major financial moves, sleep on it for at least a week. Create systems that guard you from impulsive emotions, sabotaging decades of wealth-building strategies. Feeling is natural. Acting on those feelings in money matters is dangerous. Emotions create poverty loops. Logic builds financial security. Number 6. Stop fearing investments you don't understand. The fastest way to stay broke is to let fear freeze your money in a checking account that earns pennies in interest while inflation chews it alive. I don't understand stocks. Real estate feels risky. Index funds sound confusing. That's the choir song of the broke. Take $100. Test it in a broad market index fund. Watch how your portfolio moves over 6 months. Learn by doing, not just fearing. Pick one real estate webinar. Learn house hacking or rental properties at entry levels. Not because you'll become a mogul overnight, but because dipping your toe builds familiarity. Once something feels familiar, fear fades. Inflation eats stagnant money. Knowledge keeps wealth alive. Avoiding investments because they seem complicated is like refusing to learn to drive and then complaining you can't get to work. Wealthy people steer. Poor people freeze. Number 7. Stop romanticizing debt. Debt is the oxygen of poverty. It feels like relief in the short term, but it strangles growth long term. And yet, many cling to it, almost like a twisted romance. Swipe the card. Sign the loan. Tell themselves it's normal because everyone's in debt. Truth? Debt is the quiet tax on poor people's dreams. Wealthy people use debt like a scalpel, surgically and strategically. They might leverage debt to buy a rental property that pays them consistent cash flow, or they borrow cheaply for equity growth in businesses. Poor people, by contrast, use debt for everything that loses value: gadgets, clothes, weekend experiences. You don't have to swear off debt, but you must kill romanticism with it. Love cash flow, not credit limits. Love equity growth, not instant gratification. Use debt for assets, not liabilities. The minute you shift this perspective, your financial destiny shifts too. You don't need privilege, genius, or miracles to stop being poor. You need clarity, discipline, and systems. Poverty is a cycle built on habits. Wealth is a cycle built the same way, just different habits. The real reason people stay poor is because they refuse to think long-term. The real way to escape is to commit to boring, predictable, but unstoppable systems. I know that success comes from consistent learning. If this video gave you new insights, like it, share it, and subscribe to Continue Building Wealth with me. Now, if you want to strategies average people use and become millionaires, Then watch this video. I'll see you there.